And here we go again. Today I have a very interesting topic to you about the 3% CPI and why the Fed is keep raising interest rates despite that everybody says it shouldn't do. But before we do that, we need to understand what's going to happen on the next week. Pretty exciting week, but not for the US dollar. On Monday, we're going to get GDP, industrial production and retail sales data at 4 a.m. in the morning. This is all in Central European time. So the Chinese reveal how the economy is working right now, and there will be the day 4 at the G20 meetings. So we're going to continue watching this and let you know all the information on the Pro server. But in the European Union and the United States, it will be quite calm. Maybe there is only one exception, the Empire State Manufacturing Index, but we already know what to expect from the manufacturing index, so it wouldn't be a very big surprise about that. So if we go back to Tuesday, Tuesday will be a little bit busier day. In the morning at 3:30, as I said, Central European time, the Australian monetary policy meeting will be, which is a very useful, but at the same time, the Australian dollar could experience some kind of movement. But I would like to highlight that's not about the US dollar or not against the US dollar, but rather against weaker currencies like the Japanese yen, etc. So that will be day 5 with the G20 meetings. And after that, in the afternoon, Canadian CPI numbers are coming, and we're going to focusing on the median CPI and the core CPI. And then also in the afternoon, there will be core retail sales and industrial production data from the United States. This will be very interesting, both from economic-wise, and probably the DXY will experience some kind of busy movement. The DXY is, as you know, the US dollar index. So if we go to Wednesday, there will be New Zealand CPI numbers, and then at 8 o'clock, also CPI and core CPI from the United Kingdom. And as we all know, the United Kingdom is in a pretty big trouble, so this data will be very important for the BOE. So at the next BOE meeting, we probably will see how they're thinking about fighting with inflation. And also at 11 a.m., European final CPI and core CPI. These data don't have too much effect on the euro exchange rate, but in order to investigate the economy on a proper way, we need to know this, and there will be a very important consequences, I believe. So we will see what Lagarde will tell you about the future plan of the ECB. And then Thursday, again, Australian employment change and unemployment rate. So the Australian dollar is pretty busy on this week. And then in the afternoon, 2:30 Central European time, the unemployment claims from the United States, which is not rising enough just yet, but we are really closely following the details because the summer rush is on, and it's a very interesting time. But later on, I'm going to explain to you why, so you will understand what to watch now. And on Friday, we're going to get UK retail sales, also very important data. Public sector net borrowing, which is not highlighted here, but at the same time is very important because we can follow the public borrowing levels. And I believe in a country where almost everybody has some kind of loan, this is a really important data. And at afternoon, Canadian core retail sales and retail sales going to come. So next week is not really about the United States dollar, but rather Europe is in the highlight, and also the Australian region. And now here is a little explanation about what the 3% CPI means and how should we understand when the Fed says they're gonna keep raising rates. Now, it's a very important topic, and I want you to listen carefully, because then you will understand that the actual inflation is not really low enough. So first of all, you see 2 lines, one is white and the other one is blue. I would like to represent the time where we are right now, and I would like to represent with the blue that where we're gonna, or where we want to go. And in order to understand the current circumstance, we of course need to understand what the CPI means exactly. And here is a yellow line which trying to represent the CPI movement. So as we all know, there was a really big increase on the CPI numbers. And then suddenly, when the Fed started to raise rates, the CPI started to decline as well. And this is a number, but everybody watching. And now, as you can see, this is pretty good. So what's happening? The economy is absolutely perfect. There is a very low amount of inflation. And so we can start our life as we did before, or at least before 2020. No, that's not the case actually, because the CPI is a much more complex situation. What I'm going to explain to you, but before I do, you need to understand that there is not just one CPI what we're really watching, but there are 2. The second one, which will be represented in orange line, is the core CPI. Now, the difference between the CPI and the core CPI is that the core CPI, it takes off the energy and food prices because they are really, really volatile. So we're trying to get an information about the actual inflation data as an average or closely as an average. Now, as you can see, the CPI was in a sharp decline, but the core CPI did not really decline. It's actually hovering instead. It's very sticky. And there is a reason why very sticky. The last core CPI number declined to 0.2%, which was the actual average before 2020. But if we need to take an average, that's somewhere between 0.45 and 0.5% currently, which is extremely high. So what that data shows us, that if we take off the energy and food prices from the calculation, there's everything else very expensive. And so how is that the CPI is at 3%, sharply declining? It tells us there's no inflation, but the core CPI is still very high. It's sticky. It doesn't want to decline as much as the normal CPI number. And there is a good reason for that. So in order to understand, you need to see what the current CPI means. As you see on the chart, with the red color, all items increased prices compared to last year, June. And also food prices are still increasing compared to last year. In fact, all items, which is less food and energy related, is increases compared to last year, June. And the only one decreased a lot, I mean really a lot, is energy prices. This means that the decline of the energy prices are way more overweight the increase of everything else, and therefore the CPI is able to decline. So actually the data does not really show the true inflation, but it shows something instead, and this is the energy. But don't forget, energy prices are artificially suppressed, so it did not decline because of the supply and demand level, but rather they started to play with the energy numbers. And we see the danger of this because every single week we're reporting about the Saudis' aggression of increasing or trying to increase oil prices. And if you want to understand a little bit more, this is the current CPI data that has been published a couple of days ago. So what we see here is that actually all items are in positive increase compared to last year, June. And that means food at home, cereals and bakery products. But meat, poultry, fish and eggs, the only one which is on minus 0.2%. So the only price what really declined in the food industry, but everything else is up 7.7%, 7.1%, 7.6%, etc., etc. If we go to the energy prices, as we can see, groups like energy commodities, fuel oil, motor fuel, gasoline inside, energy services like electricity and utility gas services. Now, we have a huge decline here, but the decline is not what you pay. What you pay is the electricity and actually is going higher, 5.4% compared to last year. But everything else is actually declined. So the market price is declining in energy big time, but you're still paying the higher prices. But if we calculate the CPI will see the decline only, not the increase. I mean, seeing the increase as well, obviously, but 5.4% increase compared to minus 18, minus 26, 26, 36, 26, etc. That's a pretty high balance. And if you go down a little bit lower, all items less food energy related, as like new vehicles, used cars, medical care commodities, etc., they are also increasing again. There is a couple of decline, for example, airline fares, which declined minus 18.9% compared to last year. And also we got the used cars is declining with minus 5.2%. But at the same time, everything else is up 16%, 12%, 8%, 4%, 7%, 8%, etc. So this is a huge increase again in average. And that is the proof that the CPI is actually does not show the real inflation because we have so much overweight data from the energy sector that is actually declining to 3% right now. And here we are, the third really important factor in this situation to understand what is actually going on, which is the Fed itself. Now, the Fed rate goes higher for a long time, and they did not cut just yet, so many wishing, but they didn't. The only thing we got is a Fed pause last time. Now, why is that happening actually? The reason why the Fed keeps the rate high is because they see the exact data that technically we got the core CPI, which does not want to decline, but we got this normal CPI is declining only because of the energy. So if we take off the energy, that means the inflation is still high. That means the Fed still needs to fight against the inflation because that's the only tool to fight against inflation. So here we are at the fourth point, which, the fourth really important thing to watch is the energy prices. Now, energy prices are in decline, as we know, especially oil and natural gas. And the reason for that is because the US is playing with the numbers very, very nicely. Obviously, they have to, because if they don't, the CPI would be at about, 10 to 12%-ish. So as we can see from this oil chart, there was a period when the oil was really aggressive to the upside and then the decline started. Now, the decline is not good, especially not good for Saudi Arabia because they're losing money, or they don't want to lose money. They're fighting to increase the oil price very aggressively. It's so far unsuccessful. Not very successful. There was a little bit of increase, but that's not enough for the Saudi Arabia. But also the interests are not the same within the OPEC, so they are fighting with each other as well. And that's why we do not know how much power the Saudis actually have. So if you're following at our website, we're continuously reporting about that situation. And now you might start to understand why it's really important. It is really important because if the energy prices would start to rise again, the CPI has no any other reason to stay at 3%. And here is the fifth point, which is the human factor in this, which is the employment. The employment is pretty much strong in the United States. That's not a surprise. Because obviously people are losing jobs a lot, but at the same time, the US government is trying to balance this out. So they're creating jobs and there are a lot of people taking second or third job in order to fight inflation at home, which is a pretty nasty thing anyway. So therefore, the employment keeps itself in a high region. There is a very low rate of unemployment and there is pretty high employment. And this is why exactly we get these numbers like 3.6%. If it would go up to 5%, we would say that the unemployment rate is starting to really rising in a trend-like way. But as long as it's not happening, we must say that the employment is actually pretty strong. Not to talk about the holiday season, which is just about to kick in. So here is the next factor, which is the Fed. And what the Fed says. So why Jeremy Powell and other Fed members saying that they want to keep raising rates? And the only question is how. There are several scenarios and what they say that keep watching the data helps them to decide. And you know what? The Fed doesn't actually lie. They really do what they say. They keep watching the employment, the core CPI, the CPI, and the energy prices. Because this is what's going to tell them how to fight inflation, which two possible scenarios I'm going to let you know at the end of this explanation. But that's the reason why Powell always says more restriction is coming, including possibility of hikes at consecutive meetings. Which means he doesn't really talk about the size of the rate hikes, but he's pretty much confident there will be more. And it's not an accident. They are watching the oil changes. So if you want to keep following the dangers of the oil and the energy sector, just follow us on our website. And we're going to posting every single new details about Saudi Arabia and the oil sector. It is really important right now. But when we're talking about employment, we need to talk about also the holiday season because that's a kind of danger. But danger together with everything. So technically, if the employment is keep rising and keep strengthening, this will send a signal to the Fed that they need to be more aggressive about tightening credit conditions and make people's lives harder because that's the only way that you stop spending at the shops. However, if they could raise the rates into a level when credit conditions actually tightening people's life circumstances, that would create a decline in the employment and that maybe ease a little bit so the core CPI get a little bit of chance for declining. And here comes the big question, when the Fed pivot is actually going to happen. Now, this is not a question of an exact date. This is exactly what the Fed says, that they keep watching the data. And if the data says they need to be more aggressive, they have a chance to decide whether how to be more aggressive. What the Fed pivot actually means, or what the circumstance we need for a Fed pivot is one, low CPI, so low inflation, high unemployment rate in making sure that the people don't really spend too much. We need slowing economy therefore, and most likely a recession. And then, if we get all of them, we're going to get the monetary policy change, which is for easing the damaged economy. And here is the fact. This is all about a damaged economy. So it's not going to happen when the stock market is up all time. It's not going to happen when everybody is spending everything. It's going to happen when everybody is destroyed to the ground. So the main problem, as we can see, is actually the core CPI. Now, the core CPI is sticky. It doesn't really rise because it can't really rise. And the reason is the low energy prices, and at the same time doesn't really fall with the CPI either because everything else is very expensive, as I showed you on the list. So the core CPI is sticky and is waiting for the decision where to go from this point. At the same time, the future of the CPI number is also a question because the low CPI is not good enough for the Fed. As I told you, we also need the core CPI. So the first thing they need to fight with really is strong employment. Strong employment is a danger, a really, really big danger. And a couple of weeks ago, I had a video when I was explaining to you if the summer holiday time, a summer holiday season kicks in, this will be a danger because obviously that will create inflation. Now, at the services PMI numbers, we're already seeing a spike to the upside, and that's mainly due to the hospitality strengthening. While the last employment change data also spiked to the upside until almost 500 key, which means there is a really, really strengthening employment environment, and that is a really danger. This is very inflationary because more people to work means more people to spend. More people to spend means more CPI increase. So when the Fed is trying to figure out what to do from this point, they also need to take care about the energy prices as well. Now, currently, they are driving the energy prices very well. I mean, this is not a Fed, but most likely the US government. If energy prices starting to increase because Saudis are aggressive enough to increase oil prices, this would make a really, really big danger for the Fed. And if that happens and energy prices spiking up, the Fed could come back and say, okay, we're going to keep raising rates, but for now, not with 25 basis points, but with 50, 75 or 100. It depends on the employment. If the strong employment is still the case, that definitely means a very high interest rate hike. But if the employment could go back, energy prices spiking up, but not too much, so we can get the core CPI sticky and the CPI maybe rising just a little bit, this would be a scenario when the Fed comes back and say, okay, we're going to keep raising rates with 25 basis points, but in the entire 2024, which is a little bit scary. So few of the banks are going to go bankrupt in this situation, which is not a surprise because they're tightening credit congestion. At the same time, there will be no Fed pivot until the CPI drops over the years. The question is the US government and the plan of the US government, how strong they are in order to keep energy prices down. Because everything is about energy prices. So technically, if the oil price goes up between $80 and $90 or $90 and $100, that would be strong enough for the Fed to come back and say, okay, now we're going to start with a 25 basis points, but then maybe continue on 50 if energy prices will not go back down and the CPI starts to increase again. Because core CPI is just not able to decrease with high energy prices, and that's pretty much obvious. So what we need to watch really in this situation is four fields. One is the employment, one is the core CPI, one is the CPI, and one is the energy prices. But the CPI is at the moment less important because it's at 3%, but that doesn't mean low inflation. So most likely core CPI, employment and energy prices will be the most important data to watch in the next 3 months. And if we follow close enough, we can figure out what the Fed next step will be. Obviously, it's not about the stock market because the stock market is weak already. I mean, big fishes are not buying right now. Mostly retail trade drives the market. There are put contracts coming up day by day, so it's all a scary situation. And I believe the energy prices is the main focus on the whole market. So I hope I could help you a little bit better figuring out what is going on behind the scenes and why the 3% CPI is actually not a low inflation number. And therefore, this is not a good news. So earnings season is ahead. And if you start to receiving bad data, that means that the stock market will tired of buying everything. And most probably, we're going to start some serious decline phase. I hope you're going to stand on the right side. And if you want to be close to a real information, better start following us on our website and also on our Pro Discord server so you can get all the information you need from the macroeconomic field. If you have any question, just leave it in the comment section and we try to answer at our best. Until then, see you in the next video.